Hi, good evening. Today is 3rd of July 2025. Today I'll be covering the subject of credit ratings. I find this particular topic to be the least talked about, least discussed amongst people. So I thought I'll attempt and put some clarity on the subject. And I'm hopeful that this is of some value to you. So, before I begin, the source of my information today is ICRA, which is a rating agency itself. So, all the information that I have got for the purposes of this presentation has been derived from their website. You can please visit the website, and if you want to dig deeper into the subject, you may do so at your own discretion. So, anyway, without wasting much of the time, let's get started with the subject. And let us first address the question, what are credit ratings? So I have tried to put a very simple definition to it. Credit ratings are a score that tells a lender, investor that how trustworthy, credible, able the company is when it comes to borrowing money, A, B, paying back the borrowed money. Now, what a credit rating does is gives you a score as an individual, as a company, that how credible you are when it comes to you borrowing money from a lender, A. B. How credible you are and trustworthy you are when it comes to repaying the money that you have borrowed. This is all what the credit rating does. If I were to put it in a very, very simple term, what a credit rating does not do is equally important. A credit rating is not an endorsement of a company. A credit rating is not an endorsement of a stock. Yeah, it is just a score with regards to the borrowing ability and the paying ability of a company. End of story. It does not do anything other than this. It rates you how credible you are when it comes to borrowing money, and it will rate you how credible you are when it comes to paying back the money that you have borrowed. That's it. That's all what a credit rating is. Now, what types of credit ratings are there? There are only two types of credit ratings. A, there are short term credit ratings. B, there are long term credit ratings. Yeah, let's understand it further. So, what all, which all parties are included when it in this equation of credit rating? So, A, there is a company. Yeah. B, there are there is a lender. C, there is an investor. So there are three parties involved who will use this thing called a credit rating. So let's start with the company first. The company needs to borrow money. What uses this money for? I mean, why will a company borrow money? There can only be two uses. A, the company will borrow money for working capital requirement. This is defined as short term. The company may need to borrow money for expansion. This could be for long term. Yeah. Only two reasons primarily why a company will uh, borrow money. Yeah. So the company will borrow money for these two purposes. When it comes to a lender could be a bank, could be a non-bank, could be public, could be an institution. Yeah. And these lenders will lend the money to the company, and before lending the money they would want to check the profile of the company. A, they would want to see the strength, the fundamental strength of the company, and they would want to seek an external opinion before lending the money. Yeah. So a company needs to borrow money for short term and long term. The lender, which could be a bank, public institution, will lend the money. But before lending the money to the company, they would want to run a profile check. They would want to assess this strength, the fundamental strength of the company. They would want to seek an external opinion, which is independent. Yeah. This is what the lender would do. Third, investor. Investor could be an institution, investor could be retail, and both of these category of investors, before investing into the company, would similarly want to check the profile of the company, the fundamental strength of the company. They would want to seek an external opinion on the borrowings of the company and its ability to pay back its borrowings. Yeah. And they would want a independent view on this. So this is where a credit rating agency will come and will say that, listen, I will rate the credibility of this company for short term borrowings and long term borrowings basis my independent score. You can gain confidence to lend money to this company to an investor. Please refer my independent report. I will score this company, and basis that score, you may feel confident before investing into the company. Make your own wise decision. That's all. That's what the equation is, and this is where a rating agency comes into play. Yeah. Now, two aspects. Step one is the rating agency rated the company. So there are different scores for easier understanding. Only for the sake of this presentation right now, let's say the best score is 1, average is 2, worst is 3. Let's say the company has rated, the rating agency has given a company a rating of 1. Yeah. The lender, any which way, did their own diligence before lending the money, but they also wanted an external opinion, which is independent of the company and independent of them. They referred to the rating. The rating was 1. Basis this, they gained confidence and they lent the money to the company. Step 1 done. Now comes the question, what is the ability of this company to pay back? Again, the rating agency on a periodic basis will go to the company, rate their borrowings and their ability to pay back and score them. Is their ability to pay back 1, which is best, average 2, 3, they may default. How is this information useful? This information is useful for the investor, because as an investor, you would want to invest into fundamentally strong companies. A fundamentally strong company should be able to A, raise capital via debt easily, B, be able to pay back its borrowings. Yeah. Now, this is an ongoing process. It is not a one-time event. Hence, ratings are also ongoing and not a one-time event. The rating that you got, let's say in the first half of the year, could change in the second half of the year. So this needs to be checked periodically. So far we are good. Let's go back. Let's go back to the basics here. So what are ratings? We defined that. Types of ratings, we defined that. Short-term ratings, long-term ratings. Now, ratings are only for two purposes: borrowing money and paying back the borrowed money. What are these ratings? If the rating is high, it means they can easily raise money. By they, I mean a company. A company can easily raise money via debt and will pay back on time, safe to lend, safe to recover. Simple. That's the highest rating. Second, if the rating is moderate, it means the company will be able to raise money via debt, but not as easily as company with a higher rating, and will pay back on time but could delay. So there is a slight element of doubt there. Third, if the rating is low, it means that the company may face challenges in raising money via debt and may delay and in some cases default, which means risky to lend, risky to recover. One needs to be very, very cautious. This is all what a rating agency does. Rating agencies' purpose is to furnish their independent view on the company's ability to raise money, why debt, and the company's ability to pay back and service the debt. As an investor, it is your discretion how you interpret this data before investing. As a lender, it is your discretion how you interpret this data before lending. So let's say I'm an independent agency, rating agency, and I have a friend. I rate him as 3, which is very risky. Yeah, I rate him as a risky profile to lend the money to. You come as an investor, you still want to take a punt on him. Your independent discretion. I am not endorsing whether my friend is able to raise or pay back. It is your independent. My job is just to furnish the data to you. This is what I feel independently of my friend, that this could be a risky person to be lending the money to and recovering the money from, or this person is safe to lend the money to and recover the money from. That is all what a rating agency does. So good. Let's move forward. Now, I referred this website, ICRA, which is a rating agency, as I said. So all the source of this information that I'm sharing for the purposes of this presentation has been derived from this website. So it is very credible information. That's my source. So there are two types of ratings, as we discussed. There are long-term ratings, which are used primarily for expansion, etc. And there are short-term ratings, which are primarily used for your working capital requirements. Now, long-term ratings have been defined into multiple categories, starting from AAA, AA, A, triple B, double B, B, C, D. In simpler terms, I categorized my friend into 3 categories. He's safe to lend, okayish to lend, can default, most likely may not, very high likely to default. So in my simple language, I defined my friend's profile into 3 categories. A rating agency does it in a little broader fashion. So the top rating is AAA, highest degree of safety regarding timely servicing of financial options or obligations, lowest credit risk. AA, high degree of safety regarding timely servicing of financial obligations, very low credit risk. Now very low, and here it was lowest. That is the only differentiator. A category, adequate degree of safety regarding timely servicing of financial obligations. Now high degree of safety has become adequate, and in AAA it was highest. So there are, you need to read between the lines. There is a fine change. AAA is highest degree of safety. AA is high degree of safety. A is adequate degree of safety. AAA is lowest credit risk. AA is very low credit risk. A is low credit risk. So you can see the sequence here. Triple B, moderate degree of safety regarding timely servicing of financial obligations, moderate credit risk. Now comes, it gradually moves towards the riskier side. Double B, moderate risk to default regarding timely servicing of financial obligations. B, high risk of default regarding timely servicing of financial obligations. C, very high risk of default regarding timely servicing of financial obligations. D, in default or expected to be in default soon. Now, as a rating agency, my job is to present to you this data. Now, how do you interpret it? You come across a company which is rated as AAA. In your mind, you will say that the money that it has raised, it is very unlikely that it will default, rather highly likely, almost a certainty that it will pay its money back in a timely fashion. However, if the company is rated C, the company is at a very high risk of default regarding timely servicing of its financial obligations, which means that the company can get very adversely affected in times to come. Hence, it may not be very prudent on my part to invest my money in this company. This is long term. Long terms are defined as AAA, AA, triple B, double B, B, C, D. Clear? Now let's move to the short-term rating scale. Short-term rating scale does not go as AAA, triple B, etc. It is defined in single alphabets and numericals and a numerical backing to it. A1, A2, A3, A4 and D. There are 5 categories. Now what does A1 mean? Very strong degree of safety regarding timely payment, lowest credit risk, similar to AAA. AAA was used for long term. A1 is used for short term, just a way of presenting it. A2, strong degree of safety. From very strong, it has come down to strong. Strong degree of safety regarding timely payment, low credit risk. From lowest, it has come down to low. Now let us review A3. Moderate degree of safety regarding timely payment, high credit risk compared to A1 and A2. I think it is self-explanatory. A4, minimal degree of safety regarding timely payment, very high credit risk. So which means if a company has been rated as A4, as a lender, I will be cautious before lending the money. And if I'm an investor, I will be cautious because I am doubtful on the company's profile to pay back the borrowings that it has already taken. And since the company in its life cycle will require to raise money multiple times, this company could find it very challenging to raise money if their rating is A4. Yeah. D, either the company is in default or expected to be in default on maturity. Now let's take some real life examples. So what I'll do is I'll quickly go to my favorite website screener only for the sake of presentation. This is not a buy sell recommendation. B, I am not a registered SEBI advisor. So I'm doing this presentation only for educational purposes as a disclaimer. And I'm not endorsing a company whether to buy or to hold or to sell. So please make your own assessment. So here I'm particularly taking a company which is always in the news. I'm taking Vodafone. So how do you find out where the ratings are? You A, search the company through the search tab. B, you will see multiple tabs on the top. You need to go to documents. Just click on documents. In the third column, first is announcements, second is annual reports, third is credit ratings. You will see the latest credit rating here. You click on this. This is an independent credit rating conducted by an agency on Vodafone on its long-term facilities, which are its long-term borrowings, and its short-term facilities, which are its short-term borrowings. So here the long-term borrowings that it covered is 9,968 crores. Its rating was triple B minus stable. Now we will quickly go to our presentation and we will now see what does triple B means. Moderate degree of safety regarding timely servicing of financial obligations, moderate credit risk, which means it is at fourth number. It is not highest degree of safety. It is not high degree of safety. It is not adequate degree of safety. It is moderate degree of safety, but better than high risk, very high risk, or in default already. So now you know how to interpret it. We go back here. Now, what is the rating action? As I said that once you have gotten yourself rated, it is not a one-time activity, it is an ongoing activity, which means after a course of time, it could be a quarter or 6 months or a year, you will be re-rated by this company, by an independent agency. And upon re-rating, they will change your rating post assessing your financials of the company. So their rating was triple B minus stable, which got upgraded to double B plus, which means better than before. Which means better than before. From worse than before. My bad. Triple B was moderate degree of safety. Double B is moderate risk of default regarding timely payments of obligations. So this is something to be cautious of now. Review their short-term borrowings. They had a short-term borrowing of 1,001 crores. They have been rated as A3. We will quickly go and see what a short-term borrowing A3 means. Moderate degree of safety regarding timely payment, higher risk compared to A1, A2. Now, that has moved to, as you can see here, upgraded care CARE A4 plus. A4 plus would mean that there is minimal degree of safety regarding timely payment, very high credit risk. This is how you interpret a credit rating. Now we'll also take another example so that you understand better. I'll take a different company here. Let's take ITC Limited. Yeah, again, there are multiple tabs on the top. You will click on Documents, Rating Update, and here you will see total bank loan facilities rated 1750 crores. Long-term rating is AAA, stable, reaffirmed, which means they were at AAA, they have been reaffirmed at AAA. Short-term rating A1 plus, reaffirmed. Now let's see the interpretation of these both. Short-term A1, very strong degree of safety regarding timely repayment, lowest credit risk. And their long-term AAA, highest degree of safety regarding timely servicing of financial obligations, lowest credit risk. Understood? This is how a credit rating is interpreted and as an investor. So I'm quoting you as an investor because I know lenders are not watching my presentation. Yeah, and they're not assessing whether to pay or not pay basis what they learn out of this presentation. So it's mostly for investors how to use this tool before making an investment decision. Now, in between, if you noticed, I covered that ratings are done on a periodic basis. And let us see an example where by just following the ratings of a company, how you could have gotten saved as an investor. So I'm deliberately choosing a company here for the purposes of this presentation, that is Gensol Engineering. This has been in news for a while now. We will go to document and we will click on their latest credit rating, which was done on 4th March 2025. I think I'm doing something wrong here. This was done on 3rd March. So they have got themselves rated through two independent agencies. So we will ignore the previous one. We will only refer to this one. Here, D downgraded from triple B minus. Okay. So we will go and see the company was at triple B here. I'll explain what minus is. Now it got downgraded to D. This report was published on This report was published when? 4th of March 2025. Now let's go and click on this tab called chart. When this report came on 4th March 2025, the stock price was trading at 413 rupees a share. Today the stock price is trading at 46 rupees a share. Can you see how wealth is eroded? And if you were to be tracking a company, tracking its ratings, which has been in news, it would caution you enough what to do with this company. Now, as I said, rating agencies are not to endorse a stock. There you will not find a mention on their report anywhere that whether to buy the stock or to sell the stock. Their scope is only to update you what is the current status of the company, and as investors you need to base your decision and take risk accordingly, as I would say. Yeah, let's go back. So next, let's move forward. Rating modifiers. Now, in the previous two slides, you saw that long-term ratings are done as AAA, AA, triple B, so on and so forth, and short-term are done as A with a numeric backing to it, A1, A2, A3, so on and so forth. What does minus and plus mean? The plus modifier indicates a rating at a higher end of the category, of its category, which means if someone is categorized as AA, if they are in future categorized as AA plus, which means their ratings are slightly better. But if someone is categorized as AA and in future they have been categorized as AA minus, which means they have been categorized as slightly lesser. That's all what the plus and the minus modifier does to a rating, which means I'm assessing you still in the same category, but I still need to give an opinion on you, whether you are better than before or worse than before. So I would say plus is better than before, minus is worse than before. The minus modifier indicates a rating at a lower end of its category. Modifiers provide finer gradation within each credit rating category. Only apply to categories from AA to C for long-term rating. So this is also important that this is not for short-term ratings. This is primarily used for long-term ratings. This is what credit rating does. Let's move forward. So in conclusion, credit rating provides a standardized way to assess financial risk. Credit ratings from AAA means safest, D means potential default with modifiers for fine gradation. The influence they influence borrowing costs, investment decisions, and market access. Now, when I say they influence borrowing costs, I'm a lender. You come to me and I ask you first, have you gotten yourself independently rated through an external agency? You say, yes, I have. And I want to see that report. And in my report, I find out that you are not AAA, you are less than that. So I will say to myself that, hey, the money that I'm lending could be at risk. I should be paid a premium to it. So if someone were to raise money, let's say, I'm just quoting a hypothetical example, say at a 5% interest rate to a riskier profile, I may charge 5.5 or 6, so on and so forth. It influences investment decisions. Now, companies are all the time looking for, as during the course of their life cycle, they're looking for investments from strategic investors, and they also review the company's ratings before making their investment decisions. Lastly, understanding ratings helps make better financial decisions. As I could showcase through an example, that had I been observing a company's credentials fundamentally through the lens of a rating, I could have gotten myself out early rather than allowing myself to drag till eternity and erode all my wealth or my investment in that company. So not only that, had the rating been improved, I would have continued with my investment in the company. So it is also an indicator whether I should stick with my investments in the company or not, but that is an interpretation of an investor. Independently, a rating agency's job is not to do that. A rating agency's job is just to tell you the category of risk the money lent to this company carries. That's all what it does. It is done independently through analysts, which are nominated by a professional rating agency, which are out there. Quoting a few, ICRA is one, CRISIL is one, Care Ratings is one, so on and so forth. So anyway, this is where my presentation ends. I hope this was of some value to you, and now you have a better understanding of credit ratings, or at least you got aware about the subject if it was something that you had not explored before. And I hope it helps you in your investment journey in times to come. So thank you so much for watching. I really appreciate it. And lastly, before I conclude, please like the channel, subscribe the channel, share it with your friends if you find it to be of value. And please comment and let me know what you thought of this presentation. I really appreciate that. Thanks again, and I'll see you soon. Bye bye.